It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Again, it's yourpersonalbank.com. I had an incredible week, talked to a lot of great people that have reached out to me, and I very much appreciate it. A number of people have been contacting me about what I do. I get a lot of messages each and every week. Again, I very much appreciate it. It's encouraging. As you can probably imagine, it takes a lot of time to put together a show, do the research, content, share stories. And when I first started doing it 5-6 years ago, I was hesitant at first because of the time commitment involved. As time has gone on, I've gotten to enjoy it more. It gives me a platform to be able to share stories, educate people, just try to be real, use some common sense, and help people make better decisions about their financial situation or whatever is really going on in this world that's important, that affects all of us. And so I can only just say from the bottom of my heart, I do really appreciate feedback, reaching out to me. If you want to do so, you can, of course, reach me at yourpersonalbank.com, as I stated earlier, or you can go to the Your Personal Bank app, listen to this or any of the previously recorded shows anytime you want. One of the questions I've been getting asked a lot lately, and it being still early in 2025, so a lot of people are making financial decisions, plans, what they want to do for this year, is what is it you really do? And I even did a workshop a couple of weeks ago, and some people that attended the workshop, even clients of mine, they stated, wow, I didn't realize you did that also. So I've been somewhat remiss sometimes. I get overly focused on various topics. So I'm going to just take a few minutes, if you don't mind, and just kind of share the suite of products, the various things that I do for people. First of all, as you know, listening to this show, the number one thing I help educate folks on is your personal bank. Setting up a high cash value policy to earn dividends. This is the golden era of fixed assets. So literally the returns are stronger than they've been in over a decade, are projected to continue to increase for the next decade, frankly. You can grow your money insured, guaranteed, tax-free, highly liquid. Those are rather unique aspects of many financial accounts, particularly the tax-free and the highly liquid portion of it. As many of you know, if you put your money in a policy and you just let it grow, it's just going to grow like any other investment. But what makes this so unique is the ability to access the money. You don't have that ability typically with IRAs, 401ks, mutual funds, stocks, bonds, cryptocurrencies, CDs, or anything else for that matter, annuities. The reason why is simple. Although many of those assets are purported to be highly liquid, let's take mutual funds or stocks, bonds. The problem is when you take money out of them, you withdraw funds, you have less money available to grow. Your gains going forward is less. That's the major number one challenge of nearly any financial tool. How much do you invest? And of course, how much do you withdraw? Withdrawals curtail your future growth. Your personal bank is unique in that aspect where you can use the asset as collateral for a loan, borrow against it, favorable terms in most cases where you're going to earn more in dividends than you get charged in borrowing cost, which allows your entire account, your entire investment to continue to grow. Granted, it's growing at the same rate. You have a loan interest against it, so the net overall is less, but it's still growing. The historical average over the last 42 years is about 2%, or 2% spread or positive arbitrage that you still earn. Again, here's the key part, on money you spent, on money you accessed and withdrew. You cannot do that with any other financial tool that I'm aware of. And that's why I share this concept so much, because it has so many uses. It's like the Swiss Army knife of financial tools. Because you can access the money and use it for any purposes on a tax-free basis and still earn some positive arbitrage, you can literally use this for anything you want. You can pay down debt faster. You can purchase items. You can invest in other assets and increase your rate of return. So when somebody says that a policy is you're locked up and committed to a certain amount of contributions and all this kind of stuff, frankly, they just don't know what they're talking about. They are not familiar with this tool. There's tons of flexibility in contributions. You can even put it all up front at once and not add any more ever again. That's one of the options. Plus, as you build cash into these policies over time, one of the most common questions I get frequently is, well, what if I cannot contribute in subsequent years? No problem. If you've built up some cash in the policy, for example, could you use the cash in the policy as collateral, borrow against it, and feed itself? The answer is yes, you can, oftentimes for many years, in fact. Plus, there's maximum and minimum contributions you can do annually that'll still keep you tax-free. You can skip contributions for a couple of years even. There's so many different options. You can stop altogether. We can just change the policy into what's called a fully paid up. There's so many different options. It makes it so flexible. This truly is the most flexible financial tool you can own. And that's why I spend so much time with it. But there are other financial tools that I recommend. And one of those are annuities. Now, again, annuities are often or misunderstood because there's so many different types of annuities out there. There's about 5 different types. The ones that I focus on are the ones that are principal guaranteed. In other words, no downside market risk. You have upside potential, just like many other market-based assets. You typically invest in an index, S&P 500, Bloomberg, PIMCO. There's many others, Russell 2000. But my point is, you can take advantage of the upside. I have folks that made 22% returns in their annuities last year, for example. You have unlimited upside with many of these annuities. It is, again, the golden age of fixed assets. This is the best time to invest in an annuity in over 42 years. Literally, that's a fact, cold stone fact. So therefore, you have the unlimited upside, just like you would with any indexed fund out there. But at the same time, the insurance companies provide downside protection. They guarantee the principal. That is phenomenal. I call it a stair-step approach to investing. In other words, every single year, your account's going to go up or stay the same every single year, period. For those that are looking to reduce market risk, this is a phenomenal tool. Also often used with qualified accounts, which are IRAs, 401ks, TSPs, 457 plans, all those tax-deferred type of accounts. Because one of the challenges you have with an IRA, 401k type of account is if you access the funds from it, you're going to pay taxes. So we do rollovers into annuities oftentimes, where again, you have the same upside potential you have now in a typical market investment with no downside risk. And with a rollover, you have no tax consequence either. Now, what's the limitation of annuities? There is one, and that is liquidity. And this is often confused and used as a reason for not funding an annuity or investing in annuities. Most annuities allow you to access 10% of the account value per year. You take more than that, then they impose a penalty. So oftentimes people will use that as a reason not to invest in annuities. If you have an IRA, 401k type of account, you already have a limiting factor with that account, and that's called taxes. For most people, if you take a significant withdrawal from your IRA or 401k type of account, you're going to have a significant tax bill or increase your tax bracket that you're in. Most cases, that can be anywhere from 20 to 30% or more for most Americans. So if you have a 5 or 6 or 7% penalty, let's say, on an annuity for taking more than 10%, remember the first 10% is free, yet you have a 20 or 30% or higher tax bill, that's just federal, oftentimes state on top of that, which is more of an imposition. It's the tax. IRAs and 401ks are not designed to take large amounts out in any given year. If you do, you're going to get hit with taxes. It's just that simple. Heavily oftentimes. So the limiting factor is not the early withdrawal penalty with an annuity. The limiting factor is the high tax bill you would have to pay because you took a bunch of money out and you jack your tax bill up. Annuities are a perfect fit for an IRA, 401k type of account where you want to grow the money with double-digit potential returns in good market years. Again, I have many folks that had 20% plus returns last year in their annuities, unlimited upside, yet still have downside protection. The principal is guaranteed. This is the best time in over 42 years in the golden age of fixed assets. It truly is. If you want to look into that, contact me at yourpersonalbank.com. There are tremendous returns available, as I stated. Double-digit upside potential in good market years with no downside risk. We also have annuities that'll pay you upwards of 7 to 8% guaranteed first year. Think of it like a one-year CD. Then you can invest in index options that you can allocate certain percentages in, again, with no downside market risk and unlimited upside in various indexes like the S&P 500 and others. We have some annuities that'll pay up to a 21% signing bonus up front. So if you have an older annuity, and I mean one that's, say, more than 2 years old, the newer products are far superior to anything that was issued 2 years ago or longer. And if you have a surrender penalty to get out of one of those, the bonuses will often today more than offset the cost and have increased returns, in many cases, even with their guaranteed minimums. In other words, the new products are so much better, oftentimes their guaranteed minimum return is greater than what you've been earning on the older annuities. That's how much better annuities are today. It truly is the golden age of fixed assets. Annuities have some of the highest returns of any fixed asset you'll find. It is the best time in over 42 years to consider an annuity. And again, if you have one already, it's high time to look at, could you move to a better quality one with higher returns? And even if you have a penalty to get out, get a bonus to pay that and then some. If you want more information on this, I highly encourage you to contact me at yourpersonalbank.com. I'm not saying this to brag, but I've been doing annuities for over 25 years. Earlier in my career, I was one of the top 10 annuity producers in the United States with one of the top annuity companies in the U.S. I have sold and dealt with more annuities than most any advisor in the United States. There's few that have sold or dealt with more annuities than I have personally. And I'm totally independent. I've accessed over 50 different companies. So I literally can find the best product for you with the best company. Most advisors, most agents don't have that wide range of availability of products. That's just a fact. I'm going to share a few of the other products that many of you are probably a lot less familiar with. I don't share with this as often because these are a little bit more specialized. But if you do have these situations, I think you're going to find it highly interesting. And I'll ask a simple question. Would you like a pension? Or how would you like to increase your pension? Stay tuned. I'll share with you how to do that.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I've been getting asked so often this question, certainly since the beginning of this year in the workshop I did a couple of weeks ago. What is it you really do? And as I share more of the products and tools that I offer commonly and use with people, the common refrain is, wow, I didn't realize you did that also. Because I do talk about the personal bank concept so frequently. That's the Swiss Army knife. That's the most flexible tool. You have the liquidity, tax-free, guaranteed, highly liquid. You know, it can be used for nearly anything. And it's the one that most people are probably the least familiar about. And that's why I spend most of my time educating on the personal bank concept. And, of course, that's the primary focus of the show. But as I stated in the first segment, this is the golden era of fixed assets. there's never been a better time to invest in an annuity in over 42 years. That's just a fact. We have products that are offering 7-8% guaranteed first year, unlimited upside with index strategies. I have many folks who made over 20% last year in their annuity, unlimited upside, much like many stock market investments, but they don't have the downside market risk. In other words, the gains that they locked in these past couple of years are locked in, becomes new principal. So if the market does correct, guess what? They don't lose those gains. Isn't that awesome? That's how an index annuity works. I also have products that offer up to 21% signing bonus. So if you have an older product and you want to get into the newer, better products, anything over 2 years old, frankly, is outdated. The newer products will offer you a bonus, pay off any penalty you may have, and then some. So you'll be ahead day one, literally. And oftentimes, the guaranteed minimums of the new products are even higher than what you've been earning in the older products. Some of them even with their caps, their guaranteed maximums. There were a lot of limiting factors on annuities over the previous decade because of the historically low interest rate environment. That's a whole nother story. But the bottom line is, it truly is the best time in over 40 years. If you want to look into an annuity or you have one and you want to compare, contact me at yourpersonalbank.com. I think you'll be blown away, frankly. You'll be shocked. Many of my clients have done this. They're like, wow, wish I'd done this sooner. That's the bottom line. Do you have a pension? Would you like a pension? Or if you do have a pension, how would you like to increase your pension? So these are questions I often ask for people who are looking to increase their cash flow guaranteed for the rest of their life. Your personal bank works for ages, literally age 15 days to age 80, but it's no secret that the cost of insurance and such is less for somebody who's younger. Annuities work effectively up to age 80. When you get over 80, it gets to become somewhat of a limiting factor. I can still offer some good products, but not the best available once you hit 81 plus. But guaranteed income riders are a different story. They shine as you get older, as will the next topic I'm going to cover, which are life settlements. So if you happen to be a little on the older side, you want to listen up because I've got a couple of things for you. First of all, anyone can set up a guaranteed lifetime income, or often referred to as a private pension. What a lot of people do not realize is that most pensions, government pensions, railroad retirement pensions, and others, are actually funded and backed by insurance companies. So are lottery winnings and those types of things. I have a story from some years ago. My mom, retired school teacher, she retired from the state of Missouri and then again a second time from the state of Arizona. Some years ago, there were some issues with the financials of the state of Arizona. It was public knowledge. My mom, knowing what I did for a living, asked me the question one day, is my pension safe? And I asked her a simple question. I said, Mom, when you receive the checks, your pension check, who is endorsing the check? In other words, where is the money actually coming from? Because I knew it was not from the state of Arizona. She said, I don't know, some insurance company. I said, exactly. Government agencies do, railroad pensions, and many private pensions, in fact, do, is at the point you qualify for a pension, you retire. They take your age, your years of service, and they determine a benefit amount you're going to receive. The government agency or railroad or entity shops it around with various insurance companies. This is typical. And the insurance companies bid on this benefit. For example, in my mom's case, she gets a certain amount of money per month, guaranteed for life. It's a pension with a cost of living increase. The insurance companies calculated that and made an offer to the state of Arizona, in her case, for example, and basically said, if you give us X amount of money, we'll guarantee that my mom will get this check for the rest of her life. That's a pension. That is how pensions work. Again, the insurance industry, the annuity industry, dominates pensions. Well, you can also set up your own pension or a private pension. How do you do that? We can do it one of two ways. You can start with a certain amount of funds, and we can determine how much you're going to receive guaranteed at any given point of time. So if you say, hey, I've got X amount of money, and I want to start my pension in a year or 5 or 10 or whatever time frame you decide, I can tell you, I can run a spreadsheet, compare over 50 different companies, and show you the top 3 companies that'll pay you the best pension, the guaranteed rate, guaranteed for life, depending on when you turn on that income. Now, the advantage of a private pension is you get to decide when to turn that income stream on. A public pension, of course, you have to qualify. If you fund it, you're in control. Now, there's many of these companies that will offer up to a 30% bonus on your guaranteed lifetime income or pension check, guaranteed for the rest of your life. They'll also pay you, some companies will pay you up to 14% guaranteed increase on your pension checks, your guaranteed lifetime income checks at each year you defer. So if you're going to defer longer, you want the 14% increase. If you're going to defer a shorter period of time, you might want the big bonus. I can run the numbers for you and show you the difference and show you which one's going to actually pay you the most guaranteed for the rest of your life. There's no guesswork here. The amount you're going to get paid and the amount of the increase is absolutely guaranteed no matter what happens going forward. The economy, tax rates, none of it matters. It's locked in. The other way to do it is you say, I want X amount of money income per month starting at a certain point in time. We can reverse engineer and tell you how much you need to contribute to make that happen. Again, completely and totally guaranteed. You can set these up for your own lifetime or for the lifetime of you and your spouse jointly. Now, again, as I stated earlier, this is where being older actually benefits you as a person. These numbers, the amount you receive, of course, is a combination of how much you've contributed, how long you defer, and what your age is. The older you get, it's an actuarial calculation. Obviously, you have a shorter life expectancy. They will increase the guaranteed lifetime income. So if, as a person gets older, the amount of income they will receive increases. So being older is better here for guaranteed lifetime income accounts. Again, you can start it when you're younger, defer it, and at a 14% roll-up, folks, you're going to increase your payout quite quickly. 5 or 6 years, you're going to double what the payout would have been, right, at a 14% guaranteed increase rate. If you take the 30% bonus and it rolls up guaranteed 8% each year thereafter, in 1 year, you can increase your guaranteed lifetime income or pension payment by 40% just in 1 year. Again, golden era of fixed assets. I've never seen numbers like this. This is the best time in over 40 years to set up a guaranteed lifetime income. Now, there's one more tool that's not as well known, but again benefits people, especially as they get older. If you're age 75 or older, you want to listen up. If you're under age 75 and you might have some health issues, you also want to listen up because you could qualify for this. Now, it's called life settlements. Most people may have heard of it, but are not very familiar. There are companies, they advertise, that will buy your life insurance policy. So let's assume you have a policy. It doesn't matter what type it is, as long as it's not term. Convertible term works, annual renewable term, but it can't be straight term because term expires after a certain time frame. Outside of that, you could have whole life, IUL, variable life. It doesn't matter what type, convertible term, whatever. You could have a policy that, frankly, maybe you don't like very much anymore. You don't want to continue to pay premiums on it. Maybe it has some cash value. Maybe it doesn't. Doesn't really matter. It's based on the death benefit. And again, as you get older, the more money you will receive. There are companies that will buy out your policy. They'll purchase it for you. So if you were making contributions, you can stop. Or if you don't want to anymore, maybe stop some time ago. But it's just sitting there. Maybe it's kind of dormant. But you want to pull the money out of it now for whatever reason. Maybe you got some expenses or medical bills that came up or whatever. Pretty much anyone age 75 or older is going to qualify for this. If you have health issues under age 75, you'll qualify for this in most cases. The older you are, the more money you're going to get, you're going to receive, because, again, it's an actuarial calculation, much like the guaranteed lifetime income was. So this benefits someone as they get older. If you want more information on this, recommend contacting me at yourpersonalbank.com. I have folks who are well under age 75, for example, who are funding policies with the express purpose of then selling that policy at some point in the future at age 75 or older to get a supplement to retirement. And can all be done on a tax-free basis. So it's a very, very interesting way to invest, to supplement retirement, yet have guaranteed returns, tax favored, the whole deal. So it's a very interesting way to supplement retirement that most people just don't consider. Or you already have something, we can salvage something that maybe you're not overly happy with. So again, contact me, yourpersonalbank.com, about this if you have an interest. Now, the last tool I'm going to share with you is something that even fewer people are aware of, and this one is designed for those who have larger estates. It does not have to be liquid. If you have a larger gross estate, or particularly if you have a estate tax problem, which is more and more people these days, especially with the stock and real estate markets, what they've done over the last few years, more and more people are getting caught up in federal estate tax issues, or just their assets have increased significantly. Premium financing can be a fantastic tool for someone with a somewhat larger estate. I'm going to encourage you to stay tuned in the next segment, because I'm going to share what premium financing is and what some things are to look for to determine if this might be a good fit for you, because, folks, you can set up premium financing, get all the benefits without any out-of-pocket costs. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So I'm kind of going through the list of the different products or tools that we offer that I deal with on a regular basis. I don't often share this. I tend to focus on the personal bank concept because that is the focus of this show, and it's the product that most people are the least familiar with. Lastly, Your Personal Bank, because of its ability to grow your money, insured, guaranteed, highly liquid, tax-free, and the ability to create positive arbitrage on money you spend, kind of makes it the Swiss Army knife of financial tools. You can literally do just about anything with it. Increase your rate of returns, pay down debt sooner, use it to purchase items. It's just a tremendous all-around flexible tool, has the most flexible contribution plans you can find with any tool, and definitely the most flexible ability to access the funds more so than any other financial tool that exists. That's why it's so popular once people understand it and how it works. Now, I'd also, as I shared earlier, I deal a lot of fixed index annuities. These are accounts that grow typically with index. We have some fixed options, but indexes, you get double-digit returns on good market years, unlimited upside, much like a mutual fund or any other brokerage account. I have folks making over 22% last year, for example, many of them, with no downside market risk. They limit the downside. You do have some limitations on withdrawals, but if you use it, particularly with IRA, 401k types of accounts, can be a perfect fit because you don't want to take a lot of money out of an IRA or 401k out anyway because you're going to have a big tax bill. So that makes it a perfect fit. Annuities really are. I shared guaranteed lifetime incomes or creating a private pension. This is particularly beneficial for folks as they get older. You can set up one when you're younger and defer it down the road where you can increase the amount you'll receive by up to 14% guaranteed every year you defer. That's a tremendous increase on your benefit. The guaranteed lifetime income you're going to receive, remember, it's guaranteed lifetime income. You cannot outlive this. So it's longevity insurance, if nothing else. You never have to worry about running out of money. Or you can get up to a 30% bonus up front and 8% increase per year. So in 1 year, you increase your guaranteed lifetime income by 40%. Again, the old gold, I keep saying this, but it's so true, the golden age of fixed assets. There have never been better numbers than this I've seen in my 25-year career. And these are the best numbers for annuities. cash value insurance policies and guaranteed lifetime incomes we've seen in over 40 years. That's a stone cold fact, period. Okay, I shared that earlier. The last tool I shared at the end of the last segment was life settlements. Let's assume you have an insurance policy out there. Maybe it's not doing so well, or you've been paying into it, or you're tired of paying into it, or maybe it's been dormant for a while. Doesn't matter what type it is. You can sell that policy. Companies will buy it out. It's based on the death benefit. It could be a really lousy policy, and you could really benefit. Again, more beneficial for folks who are older, 75 plus, you're pretty much going to qualify. Or if you're under 75, you have some health issues, you could easily qualify. So again, the more older you are, the more you benefit. On guaranteed income riders, because these are actuarial calculations on how much you receive on a guaranteed lifetime income, or life settlements, also really benefit folks as they get older. Now, this last one, again, is the one maybe most people are the least familiar with, but can be the most powerful tool, financial tool you may have ever heard of. And this is called premium financing. What premium financing does is it combines the benefit of your personal bank concept, the ability to grow your money insured, guaranteed, tax-free, highly liquid in an insurance policy. It combines it, though, with a bank loan that pays for the premium for the policy. For you, not out of pocket. In other words, the bank funds the policy. Of course, there's a loan. They charge you interest, but the policy is also earning dividends. Now, historically speaking, over the last 40 years plus, the spread, the difference has been about 2%. In other words, the dividends in the policy are about 2% more on average than the interest charged from the loan. So now you have an insurance policy, dividend-paying policy, or insured, guaranteed, tax-free. You can do whole life or IUL policies. There's benefits to both, but the bank funds it on your behalf. The cash in the policy is collateral for that bank loan. The only thing that's required on your part is to have a larger than average estate. It does not have to be liquid. It could be literally anything. You could own real estate, stocks, combination of things. It doesn't matter. But if you have a larger than average estate and you have the capability of putting up at least a small amount of collateral for a few years, no out-of-pocket costs, you can create a significant cash asset tax-free with an insurance policy. What happens typically is the cash in the policy grows, the dividends and stuff, overtakes the interest on the loan. Each year it does, but the amount in the policy overtakes, and usually within a decade or two, depending on your age and health, the dividends in the policy, the cash in the policy has grown to the point where it can then just pay off the loan from the bank, and now you own it outright. This is a tool that's often used for federal estate tax purposes. I'm going to use an example on a person I'm working with right now as I speak who has a $100 million estate. Now, you don't have to have that size estate for this to work. I just want you to understand this is something that is done on a regular basis. This person has about a $30 million estate tax problem. In other words, if they pass away, they're going to owe about $30 million in estate taxes. Now, obviously, if they pass away, their heirs are going to have to sell off a number of assets to pay those estate taxes. Instead, what they've done is a bank is financing an insurance policy on them. The dividends, the cash in the policy is paying the interest on the loan. After a decade or so, the amount of money in the policy grows to enough to pay off the loan. And all this time, during this time, there's a death benefit of about $30 million that will pay the estate taxes for this person at the point they pass away. In other words, their estate, the assets they own can be held, continue to pass on to their children, in their case, and the kids will not have to sell any of the assets to meet the estate tax that's due. This is a tool, again, that's often used by the wealthy to address federal state tax issues. I've used this with farmers, business owners, investors, anyone who has an estate where their assets have grown to a fairly significant amount, some of them to a very significant amount. Now, you don't have to have an estate tax problem to use this tool. Some use it just as a tool to grow more cash, insured, guaranteed, tax-free over time. There's a death benefit associated that would go to their heirs tax-free if something happened to them without having to contribute any out-of-pocket costs. They put up a small amount of collateral. In this particular case, the $30 million of insurance, they have to put up about $300,000 of collateral. And again, remember, this is an estate worth over $100 million. So $300,000 of collateral for about 7 years is nothing. You can adjust the numbers, add a zero, take away a zero. It doesn't matter. I partner with the top premium financing company in the country. In fact, they invented the industry. And we can show you how to do this. Any estate tax problem you may have, or you just want to increase an asset on a tax-free basis without putting anything out of pocket. So again, if you have a larger estate and this is of interest to you, you want to learn more about this, contact me at yourpersonalbank.com. So I think just from the things I've shared with you in the first couple segments here or so, there's a lot of different things we do for people. It truly depends on your situation, what you're looking for. But I think you're going to see one theme that's kind of common throughout all of this. Every investment asset tool that we use is guaranteed. It's insured. Most of the time tax favored or even tax free, has gains or growth on it equal to or greater than many investments in the stock market, brokerage firms, mutual funds, or anything else for that matter. Costs and fees are comparable to many index funds. So when people do talk to me, meet with me, and they start to really understand how these things work, they're very pleasantly surprised. And this is why we have so many clients who then stay with us. We have last time I checked, we had a 5-year retention rate of over 98%. And by the way, some of those that we lost actually passed away. So our retention rate with clients over a 5-year period or longer is extraordinarily high. And I think you can start to understand why as I'm sharing some of these tools that we often use with people. So again, one last time I want to share with you, if you're interested in any of these things, whether it's your personal bank, you know, grow your money insured, guaranteed, tax-free, highly liquid, get positive arbitrage. You want to grow your money safely without market risk with annuities, particularly with IRA, 401k type of accounts. Great fit for that. You want to create a guaranteed lifetime income, a private pension, if you will, or you want to increase your pension. You have a policy that you're not particularly happy with. You want to consider selling it. Well, I can shop it around all the top life settlement companies and get you the best offer. Or you have a larger estate and you're interested in premium financing where a bank will fund a policy for you. All you have to do is put up a small amount of capital, no out-of-pocket cost for you, and you create a tremendous asset, insured, guaranteed, tax-free, that either can address estate tax problems or just pass on more benefits to the heirs or benefit you down the road with highly liquid funds, particularly after it pays off the bank loan, which usually occurs around 10 to 15 years, give or take. Contact me at yourpersonalbank.com for any of these things. Now, that all took a little longer than I was expecting to share. I do have some great stuff I want to discuss in terms of the economy and the markets and various things that are going on right now. I'll share a little before I have to go, and then we'll finish up in the last segment. One of the key things, of course, is, recently there's been a shakeup at the S&P 500, this deep-seek panic, they call it, where a Chinese company created an AI that was apparently far cheaper than anything that the U.S. companies are doing. It certainly has shown an area of weakness. Now, does it mean the market's going to turn and this is the beginning of the next downturn? Impossible to know. But it does show or demonstrate significant weakness, and that being the semiconductor sector now accounts for over 5% of the entire U.S. market. That's higher than the previous dot-com bubble from 2000. So if that sector struggles or has any problems, the markets are extremely concentrated, and that is a risk. And that's something you need to watch out for. Stay tuned in the next segment. I'm going to share some more things about this, some things you need to be aware of to protect yourself from that type of risk. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you'll reach me. It's yourpersonalbank.com. So you don't need to know a lot about AI. Most people don't. But there's been a recent shakeup in the stock market that has exposed a weakness. And it's this, that the markets are extremely overweighted in the tech sector, the semiconductors, at a level I don't know that we've ever seen before. It's even higher than it was from the 2000 dot-com bubble. This Chinese company came out with a AI supposedly that was better, faster, and cheaper. That created a lot of panic in the market because investors are suddenly realizing, oh my gosh, all this investment in AI, which has been the boom lately, that's what's caused the tech sector to do what it's done in the last couple of years. Maybe these companies don't need to invest so much money. Maybe they're wasting a lot of money, and that's where a lot of the concerns come. Again, I don't know if this is the cause of the next downturn in the market, but something was going to cause it. Frankly, when you're at extreme levels where we are right now, it could be anything, folks. Anything could become the trigger that could cause the next downturn. When the market is so concentrated into such a small group of companies, the Magnificent Seven accounts for a huge chunk of the S&P 500. And one of the benefits of the S&P 500 has always been the diversity. A lot of people think, well, I'm investing in 500 different companies. Well, yes, that's true, but only a tiny, tiny percentage of the smaller companies, something like upwards of a third of the S&P 500 right now, is accounted for with just the top 7 companies. So if something causes them to struggle, like this DeepSeek thing did, that's a high-risk situation. You lack diversification. Many of these articles, Larry Summers was one of these, was warning asset bubble prices are hitting levels last seen prior to the financial crisis. As he states, investors are becoming complacent about risk. He said, we haven't seen this kind of exuberance since before the 2008 crash or the dot-com collapse. We've seen this before. We've been on this rodeo before. That's the word that I've been trying to share, or I have been sharing with people consistently. Fear surrendered to greed, and investors are far too complacent about the growing imbalances in the U.S. asset markets, again, according to Larry Summers. By any measure, the U.S. stock markets are at extreme levels. Everything has to go right. I've heard the term, they're priced for perfection. If anything, and I mean literally anything, goes wrong, that's when a correction is going to occur. There's a stock market gauge that's named after Warren Buffett. It has just hit an all-time high. It's sending a warning that's worse than it was even before the dot-com bubble. The Buffett indicator is basically a measure of the total value of the stock market compared to GDP. And it has now hit 220 or 220% of the value of the entire GDP for the entire country. And GDP is just a measurement of what the country earns in a year, all of us. By the way, before the dot-com bubble, which was the previous high or peak for the Buffett indicator, it was at about 175% at its highest point. We're at 220, folks, which means we are at higher levels than we were prior to dot-com bubble, which later burst. The S&P dropped 45%. Will that happen again? Impossible to predict, but it's certainly in the realm of possibility. I can't state this enough. When you are at extreme levels, the risk is elevated. The potential for significant corrections are enhanced. In other words, everything is augmented because we're at such extreme levels. My point I'm trying to make is, I'm not saying the market's going down today or tomorrow, next week or next, I don't know. But something will create that next downturn. And it could be very significant because the upside has been so significant. I keep bringing this up because I talk to people on a daily basis who have been involved in the market over the last couple of years or even the last decade. And that is maybe the best word I can describe. I'll say, are you concerned about a correction? And complacency is probably the best description. Well, we'll see. Things have been so good for so long. It's basic human nature. You get in a comfort zone. You get used to things being the way they are until they're not. And those are the people that are going to get surprised. My point is simple. Don't be complacent. That's where you get hurt. And as the Goldman Sachs CEO recently stated, the U.S. needs to get debt levels under control. As he pointed, risk is at elevated levels. I've shared this tidbit before. The U.S. stock market tends to drop when the 10-year Treasury hits 5%. It's currently approximately at 4.7%. The reason is simple. Big institutional investors tend to move their money out of the stock market and into the bond market once they hit about 5% returns, because if you're a pension fund, that allows you to pay your pensions, your pension obligations, with literally little or no downside risk. Insurance companies, banks, etc. do the same thing. Also, there's a measurement that measures the extra reward for owning stocks over bonds. It's called the S&P 500 Equity Risk Premium. Obviously, if you're going to take on risk, you're doing so because you're expecting a greater reward. Well, it turns out at this point, the risk premium is now for the S&P 500 is now showing a negative, which means you're actually better off owning a bond than owning a stock, according to the Wall Street Journal and the S&P 500 equity risk premium. These are things that big institutional investors pay attention to. You should too. That's my point. You should not be complacent and ignore these things. And Vanguard even has come out stating flipping from a 60-40 allocation, 60% stocks to 40% bonds, they're recommending flipping that. I don't know if they've ever done that. It's a shocking call that Vanguard is making. Again, it's the golden era of fixed assets. Certainly you could do bonds. You can do better in annuities and high cash value dividend paying policies. They're paying 6% tax free or better, and annuities are paying 7-8%, which is higher than any bond you can get right now. With the personal bank, you can still have the liquidity, much of the liquidity you have with a bond. There's tremendous opportunities right now that we, again, haven't seen literally in 40 years at a time when the market is at extreme levels. It's at a point of elevated risk. And back to the Warren Buffett, in 2024, he sold $127 billion of stock, which is the most aggressive selling behavior. He has been more aggressive selling stock than at any time before ever. Historically, each time Warren Buffett has aggressively sold stock, the following 3 years have been negative return, folks. He's known as the Oracle of Omaha for a reason. You might want to pay attention to what he's doing. The last couple of key things. There's been so many changes with the new administration. We got to bring up a couple of key points, particularly from an economic standpoint, that I think are going to be valuable to recognize. First of all, it was already known that about 13% of Americans work directly for the government. That's the federal, state, local governments. But it turns out that there's about 13 million nonprofit workers who are subsidized mostly, if not entirely, off of government grants. They call them NGOs or non-governmental organizations. But you really have to ask yourself a question. If you're a nonprofit or a consultant or a contractor or whatever, you don't work directly for the government, all or nearly all of your funding comes from the government. Are you really a non-government organization? You're a non-government or NGO in name only. You're still really working for the government. When you put the two together, about 25% of the workforce, Americans, work for either the government directly or indirectly. Now, based on some of the actions of the Trump administration, offering buyouts, forcing them back to work, all these types of things are very likely going to significantly decrease the number of government workers, both directly and indirectly. Many of these grants have been shut down temporarily so far, but likely will become permanent as they are deemed not necessary or in the best interest of the United States. We're going to see a significant number of people not working anymore. Unemployment likely is going to go up for a while at least, but government spending will go down. In many ways, they'll offset each other. And in the long run, frankly, it'll be a good thing because Government workers, government agencies, for the most part, do little or nothing to contribute to the economy. It's truly amazing that our economy actually has been as good as it's been, given about a quarter of the workforce is sucking off of it, if you will. It's like a leech. It's like our economy, we're running a race, competing with other countries and such, but we got this 25-pound backpack on our back trying to run the race, which is clearly slowing us down. Think about when that gets that extra weight, or much of that extra weight gets lifted off. We could see a tremendous economic boom. It'll take some time to convert to that, a year or two, frankly. In the long run, could be a tremendous benefit. Also, President Trump has signed an executive order banning central bank digital currency. This is great news for privacy or the government watching our every move and controlling us. So I'm very much in favor of this. You know, most of us, including myself a few years ago, really weren't that focused on politics and what the government was doing. So we didn't get involved with politics because we wanted to. We simply wanted to be left alone. We just wanted to live our lives. But the last administration could not leave us alone and allow us to live our lives. Got involved in our lives, shut down our economy, shut down our jobs, our careers, interfered, forced mandates on us, and all kinds of other stuff that woke people up and forced us to pay attention. What they don't realize, and this is what encourages me the most, is it's like you woke up the sleeping giant. Much like in World War II, where we got invited by the Japanese in Pearl Harbor. We didn't want to get involved in that war, but you bomb us, you attack us, we're going to wake up, and you're going to activate us. And now we're here, and we're not going away. So I'm excited, again, about the medium to long-term future of our country. We have some speed bumps to get through. We got some challenges to get through. We'll get through them. It's going to be a bit of a bumpy road. Reduce your market risk in the meantime. Keep your money liquid. You can do that with your personal bank. Keep it highly liquid. If you're interested in any of these other products or tools I shared, whether it be annuities, unlimited upside gains with no downside losses, guarantee the principal. You want to create a pension, private pension, guaranteed lifetime income. You have an old insurance policy that you'd like to sell, you're about 75 plus or have some health issues, want to bring some more money in for whatever reason, or you have a larger estate and you want to have a bank fund a policy for you so you have no out-of-pocket and you create another asset that's tax-free, liquid, guaranteed, contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.